like a butterfly flapping his wings deep down into the forest, man. It's gonna cause a tree fall like 5,000 miles away, man. There ain't nobody seeing nobody. Man, see, like, you don't even know, man. It's like you're born into this world, man. And you got like that, man. The dust and wind, man. Or like a dang old candle, man. It don't matter, man. It's all the time.
All right, Robert, Infranomics, how you doing, man? Doing quite well. Thanks for coming on the show. Really enjoyed a lot of your work. You were recommended by a mutual friend, and yeah, man, you do very high quality stuff. So if you could just describe, who you are and what do you do on the internet?
Yeah. So first of all, I never expected to be someone on the internet. I never expected to be one of those people. So I don't really know what I'm doing, first of all, and I don't have a business plan. I don't really, nothing. This was not my dream from a young age or anything like that. So that being said, yeah, I got interested in macroeconomics, international trade, kind of global capital flows, sociological issues that intersect, of course, with economics, all those sorts of things. I started getting interested in markets in 2019, but then, of course, 2020, all the chaos and volatility from 2020 onward got me really interested in trying to figure out how it all works. I've kind of always been very nerdy from a young age, and yeah, I saw kind of global markets as kind of the world's biggest puzzle that I really was determined to figure out. So yeah, I dove in quite deep, spent an absurd amount of time listening to various podcasts and academic speeches at various schools of economics, and all free on YouTube, and reading Wikipedia and Investopedia and various academic papers on monetary policy and all these sorts of things. And yeah, just really dove in deep, was determined to figure it out, and kind of came out the rabbit hole, or came out the tunnel, I guess, 5-ish years later. And it started to finally click about maybe a year and a half or so ago. Started to kind of feel like, okay, I think I really actually understand this after, I don't know, 12 hours a day of for the past 5 years. I think I got to a point where I was pretty felt like I grasped the material pretty well enough to kind of start talking about it, I guess. And some of the things that I had noticed in just diving deep into charts, whether it be on TradingView or Fred, which of course is the Federal Reserve. And just kind of felt like it was time to start talking about some of the things that I had been seeing and that were concerning from an American standpoint, from a young male standpoint. Of course, we know various issues there. So yeah, kind of felt like it was time to start vocalizing some of these things, and then ended up making a YouTube after my Twitter or X account that started to do well and kind of really take off, and decided YouTube was kind of the next logical step. So started YouTube, and yeah, it's just been kind of figuring it out as I go ever since.
Yeah, fair enough. I was in business school, actually, getting my finance degree during COVID, and I had a very funny interaction just stuck in my brain, where one of my economics professors, and I should say, was a terrible student. Did not learn anything, largely because of COVID, but I bear some personal responsibility as well. And it was the middle of everything that happened. And he basically stopped class and he said, "You know what? I'll be honest, I don't know why this is happening. And according to everything I'm about to teach you, this shouldn't work. But you still have an exam at the end of it, so we have to go through it anyway." Which was sort of an interesting moment, like an interesting admission, that it seems as if from his perspective, and look, this is a guy who is an economics professor at sort of a middling program, right? Not some kind of, leader in his field. That was kind of a funny admission. You do videos fairly regularly, and so in preparation for this, I've gone back through some of your backlog. And one of the ones that came out just a few hours really before recording this was about consumer debt. So as someone who is not a financial analyst who really knows nothing about the economy, I've noticed sort of, shall we say, trailing indicators of this. I've noticed that you can get a consumer loan for a burrito, for example. Like you can DoorDash something and get a loan for it. And I've noticed that same sort of creep everywhere. And so, okay, we can, clutch our pearls and talk about how that's a bad thing for society. But one, do you want to, I guess, kind of narrowly define consumer debt? And then two, like why does that matter, right? Past just being probably not a good thing to have in society.
Yeah, well, so I think first we have to kind of come from the foundation, which is our monetary system is debt-based. So the vast majority of dollars in the system actually were not printed by the government. They were not created by the Federal Reserve. They were printed by a private bank. So when a private bank goes to extend a loan, whether that be a mortgage, a car loan, personal loan, they are essentially printing money. And about 85 to 90% of quote unquote dollars in circulation here in the US from a broad view were created by a private bank. And this is true not just in the US, this is true in the UK as well. I believe over there it's actually slightly higher. I think 92%. They did a paper that found it was 92% in the UK. So this is not just a US thing. This is the case, kind of over the West, broadly speaking. Debt is money and money is debt. And so I think starting from that foundation, it's important because many people assume that their money, their dollars in their checking account and their money kind of broadly as a concept is coming from the government originally, right? At the root, it was created by the government. Well, that's actually not true. Very little of the actual dollars in the broad money supply were created by the government, especially when you get to the level of currency. Like physical currency only accounts for a very, very small fraction of the overall total dollars in the broad money supply. So with that being said, I think, and I would, by the way, point people to Richard Werner. He's got some excellent papers. I've also done a couple videos going through some of those papers to try to break it down a little bit simpler. But I would highly recommend if people are more interested in finding out exactly how that works. And he has proven it empirically through many, many papers that he's published. And of course, this upends kind of everything that most people were taught about how the banking system works. Certainly when I took economics class in high school, that was not what we were taught. But that being said, yeah. So once we realize the root of most money is debt, the debt is money and money is debt. One man's asset is another man's liability. So when the bank extends the loan, they actually get to record it as an asset. For you, it's a liability. Well, of course, you pay interest on that debt. And currently, personal interest payments per year stand at $571 billion. And that is just what individual Americans are paying to banks in interest. No principal, just the interest component, about $500 billion per year. Now, if you break that down per person in the labor force, works out to about $3.3 thousand per year annual interest expense. Now, once you break that down to how many hours of work, right? So you can denominate this figure in the average hourly wage and find how many hours of work must the average American work just to pay the interest. That number is 106. Back in 2019, it was about 60. So we've almost doubled in terms of real human hours of work, of labor. We've almost doubled the amount just in the past couple of years in terms of number of hours that the average American needs to work just to pay the interest component. So yeah, the debt burden with higher rates, of course, by definition, the US is net unproductive. We run what's called a twin deficit, which is a fiscal deficit. This is the one many people have heard of. This is government spending being larger, greater than government revenue. That's the fiscal deficit. And we've run one of those since the kind of mid-90s. But the other one that very few people talk about is the current account deficit. And this is mainly comprised of the balance of trade. Of course, we run a huge trade deficit overall, goods and services. We do run a slight services surplus, but because of how large our goods deficit is, it blows out the trade deficit. And this current account basically reflects, is one of kind of the two main accounts of a country's financial flows cross-border, and it's mainly comprised of the balance of trade. But we run a massive current account deficit as well. So you pair the fiscal deficit and the current account deficit together, that defines a twin deficit nation. Well, by definition, the only thing a twin deficit nation can accumulate is debt. You contrast that with a country like, say, China or Japan that run a current account surplus, mainly due to, again, a trade surplus. But there are other minor components that are worth pointing out, primary and secondary income. They make up a small percentage of the current account, but they are a drag overall. And just to put this in context for people, currently, as of the last data print that we got from the BEA, our quarterly current account deficit is $450 billion. That equates, of course, to $150 billion per month. And so, on the other end of that, someone is running a surplus. Well, that someone is countries like China, countries like Japan. And just as we can only accumulate debt because we're a twin deficit nation and overconsume, kind of by definition, they get to accumulate basically a national savings. And a lot of these are in U.S. treasuries, debt, U.S. government debt instruments. But of course, a lot of it is in real estate. A lot of it's in U.S. stocks. And that gets into some really interesting kind of dynamics that this current account deficit actually drives a lot of the wealth effects and wealth inequality kind of issues that we're seeing. There's a very, very strong correlation there with the current account deficit because by definition, on a balance of payments basis, everything must net out to zero. So if you run a current account deficit, the other way of saying that is that you run a capital and financial account surplus, or there are capital inflows into your financial assets, again, to the tune of $150 billion per month or $450 billion per quarter. So what we've basically created to kind of tie all that together is we in the US, broadly speaking, overconsume. Well, if we're not making enough income to support that, right? We're not selling enough goods and services to the rest of the world to raise the dollars, raise the money to then pay the rest of the world for their stuff. We know we run a huge trade deficit. So it needs to come from somewhere. Well, where does it come from? It comes from debt. And, we were in a 50-year period of time of falling interest rates from the 1980s up until, again, very recently. That allowed us, whether it was the government, whether it was private individuals, that allowed us to take on more and more debt because the cost of the debt, the interest rate was falling, broadly speaking. And of course, then, we had the great inflation and money printing bonanza and all of that. Interest rates started to rise and break out of that 50-year downtrend. And now we kind of are starting to get squeezed, especially if you had floating rate debt. But again, kind of the root, in my opinion, the real root of the problem is the twin deficit. The fact that the U.S. is net unproductive due to these twin deficits. The fact that the only thing we can accumulate is debt. And you compare or contrast that to, a country like Japan or China, which is net productive. They produce more value than they consume. Therefore, they're able to accumulate savings, assets. And a lot of those assets are actually U.S. assets, whether it be stocks, whether it be corporate bonds, whether it be treasury bonds, or whether it be U.S. real estate. They've accumulated tens of trillions of dollars. I think last I checked, it's about $60 trillion gross on a net basis once you account for the assets that Americans own of the rest of the world. On a net basis, it's about 95% of GDP, negative 95% of GDP, about 27 trillion. So yeah, this is, basically we saw the consequence of this in April, which is because we've been net unproductive, for so long and accumulated these kind of structural twin deficits, the rest of the world literally owns us. And if we start to do something that the rest of the world doesn't like, think back to early April, one of President Trump's kind of core policy promises of tariffs, the rest of the world dumps like 30 billion. Again, they have 60 trillion gross on a gross basis. They only sold a tiny fraction of that, whether it be U.S. stocks, whether it be U.S. bonds, or other kind of dollar-backed or dollar-denominated sort of assets. They only sold a very, very small fraction. Bond markets started to melt down. Yields started to spike. Dollar sharply lower. Stocks sharply lower. And they were able to force foreigners, were able to force the U.S. president to reverse and capitulate on one of his core policy promises of tariffs, at least kind of temporarily. So it in my opinion, that's really the story. Yes, of course, for the average American, this rapid rise in interest rates, to give another kind of real world example, the average annual interest expense on the average home went from about $8,000-$9,000 in 2019 per year to about $25,000 per year. So this has a very, very large impact on the affordability issues that, of course, everyone's kind of finally talking about.
Yeah, so there's a lot there. And I think that from an outsider's perspective, right, for someone who's not this really in their kind of stock in trade, it's easy to get very jaded, right? Particularly if you kind of grew up in, red American conservative circles and you remember the absolute freak out during the Obama era about the deficit, right? Oh, the deficit's going up so quickly. And look, like, it's easy to slide into that assumption that like, oh, well, it is a problem. It's not good. But also, people have been saying, oh, the deficit is a huge problem forever. And it seems as if, life carries on. I hadn't heard anyone break it down into the two sides of that deficit before. But I want to dig into a little bit more. Specifically, you mentioned the country of Japan. Because one of the things that I have noticed as someone who, again, is not following the economy particularly closely, has been the Japanese bond market, right? So on one hand, it seems like, judging off the information you've given me, Japan is, from a certain perspective, owning more and more of America, right? They're pouring capital into our system. And yet, it seems as if they're facing their own sort of, I guess you could technically say, a sovereign debt crisis, if I'm not being overly dramatic there. So if you could you explain, one, what is happening with Japan? Why does that matter? And then also, how does that connect to the previous comments you just made about Japan in relation to effectively buying America?
Yeah. So Japan is one of a number of countries right now that is arguably already in the start of a debt crisis. I would put UK and France also there as well. Although I would actually say that Japan is not nearly as bad as the UK or France for a number of reasons. Yes, they have skyrocketing bond yields. And for those that are not in the weeds with bonds, the bond value or the price of the bond is inverse to the yield. So when you see yields moving sharply higher, what that correlates to, what that really means, another way of saying that is the bond value is plummeting. This is, of course, one of the things that led to the regional bank failures of 2023 was all those regional banks had loaded up on U.S. Treasuries, long-term U.S. Treasuries, which have a dynamic called convexity that kind of amplifies losses. They had loaded up on those long-term bonds, and of course, bonds broke out of this 50-year bull market, started to decline in value quite precipitously. And so, when the banks were forced to sell the bonds to raise cash to give to the people that were demanding their deposits, the bonds were worth far less than they had money, so they were insolvent. So, with that being said, yeah, with Japan, their yields have been moving sharply higher, no doubt, for the past 2-3 years. Arguably even 4 years. What I would say with Japan that makes them a bit not stronger. They have very, very high debt to GDP. They had very, very poor growth. A little brief history of Japan for those that aren't aware. They were ascendant. And there were concerns, legitimate concerns, that Japan was going to overtake the American economic power. And so what we did is, and this has been detailed in various books like Princes of the Yen, we went over and liberalized and deregulated, and of course created the everything bubble that ended up getting blown kind of from the mid 1980s up until 1990. Then, of course, that everything bubble popped. And just for scale of how large that bubble got, one little garden in Tokyo was worth more than the entire state of California. And it was like, 1 square mile, maybe not even. It's Tokyo, so it might have even been smaller. So the bubble was quite immense. After the bubble popped, they were basically in what they termed the lost decades. And it was about, 15 to 25 years, kind of depending on when you start and end it, but a long time of very, very poor growth, very, very high unemployment, high suicide rate, just poor economic conditions, poor growth, even deflation, where prices were actually going down. Wage growth was negative. If you think your 1% annual raise is bad, imagine you're getting a 2 or 3% wage cut every year. So they had this lost decade where they had very, very poor growth. Well, as a response to that, the Bank of Japan took rates very, very low, even negative, meaning to try to incentivize borrowing, to try to incentivize kind of a credit impulse. And it didn't really work until 2021-ish, when all of a sudden they started to get inflation finally after decades, to arguably about 2 decades of basically no inflation, basically no GDP growth, basically negative wage growth. After all that time, they finally started to get inflation. They finally started to get an uptick in kind of broader growth. Well, of course, bond yields, especially longer term bond yields, the way to think of, say, a 10-year treasury yield is, generally speaking, that is the nominal growth expectation over the next 10 years. Nominal growth includes inflation and real inflation adjusted growth, called real GDP. You add the two of those together, you add a little bit of term premia, which is a minor component, and you get the bond yield. So if you have higher nominal growth after, again, 2 decades of basically 0% or even negative GDP, if you finally are coming out of that and starting to grow with inflation, with wage gains, with, I think last I checked, wage growth is growing at like 4% a year in Japan. And this is unheard of over the past, 30 years. So when you have that sort of environment, positive developments, fundamentally positive developments, you're going to get higher interest rates. And so, what we're seeing there is bond yields started moving higher for fundamentally positive reasons. We, in the West broadly, have kind of conditioned ourselves after 2008 that 0% interest rate, basically very artificially low interest rates, is the norm. Therefore, anything outside of that is actually a negative. And it can be, right? If bond yields are moving higher because capital is fleeing your country, or they're worried about huge deficits, right, and demanding a higher term premium and that sort of thing, then it can be a bad thing. But it can also be a good thing. If you're coming out of 20-ish years of very, very poor growth, there can be a positive fundamental catalyst that moves bond values down and bond yields higher. And in Japan, a lot of the debt, of course, a lot of people know debt to GDP kind of overall is about 250%, much higher than the US. But a lot of that debt is owed to itself. The central bank there, the Bank of Japan, owns a huge, staggering amount of the debt. And so it's basically like a circular sort of phenomenon. The interest gets paid to them, and then they recycle it into the Ministry of Finance, and it kind of it's kind of fugazi. So when you look at the external debt, which is really what matters, it's actually quite low. And so, yeah, I would put Japan, yes, they have higher bond yields, very sharply higher bond yields. But I would argue that they started due to fundamentally positive developments. Now, that's not to say that you couldn't have a bank failure, right? Part of the reason I mentioned what happened with the regional banks here in 23 was because that is one of the consequences of having plummeting bond values, which is that, banks, pension funds can run into problems. And basically the Japan's got a choice, right? Do they let that happen? Or do they not? And governments always have a choice. Generally speaking, they choose, to save the system. So that's kind of the default. But yeah, what I would say with Japan, I would argue that's even probably worse for America, because you mentioned the huge amount of savings that this positive net international investment position, they own over $1 trillion of U.S. Treasuries, just for one. But of course, also lots of real estate, lots of stocks, U.S. stocks. So I would argue that, the real risk with Japan is that rates start, because again, they had very, very low rates, like 0% or even negative interest rates at the short end of the yield curve for so long that, like, Japanese people, if they wanted to save, the yen was weakening. So they got out of the yen, got into the dollar, which was strengthening. So they're making money there. But then, of course, not only that, but then they take those dollars and invest them in U.S. real estate or U.S. bonds or U.S. stocks. Those go up in dollar-denominated terms, so you make money both directions. So really, in my opinion, the risk with Japan, yes, there is a risk that, a bank or a pension fund or a couple fail. But I think that the real risk is that, finally, all these trillions of dollars that have left Japan during the kind of, cumulative period of time that they were running a bilateral surplus with us, that those accumulated savings start to come back to Japan, right? Because if you're a Japanese investor, you look at a 0% yield on your 2-year JGB, you look at the yen, which was weakening, and you go, I want to get out of the yen and I want yield. I want, 4% in America. So you sell the yen, puts even more downward pressure on the yen. Buy the dollar, puts upward pressure on the dollar. Then you use those dollars to then go buy dollar-denominated assets that, of course, we know kind of go up and to the right. So really the risk is, they have accumulated huge amounts of U.S. assets. If the yields start to get high enough in Japan, you could get a wave of capital repatriation where that capital starts to come back home and they start to sell U.S. stocks, sell U.S. treasuries, sell the dollar, and then, of course, buy the yen to then buy JGB. So I think that from a debt crisis lens, I would argue that UK and France are worse, significantly worse. And from a who really bears the risk with Japan, I would argue that it's to a larger degree the US. They can have a bank fail or a pension fund fail and just say it is what it is, right? And free markets, right? So they have the choice, right, to let a bank fail or a pension fund fail, and nothing like that has even started to happen yet. And yields have been rocketing higher for, again, like about 3.5 years. So none of that has really started to happen. And so yeah, I would point, with the situation with Japan, I would point to the real risk being that the yields start to get high enough that they start to repatriate some of the capital that they have stored over in the U.S. piggy bank back home. And of course, that would drive U.S. yields sharply higher, stocks, right, bonds down, stocks down, and the dollar down is kind of what that looks like. So yields up.
Yeah, so essentially as capital returns home, it plummets here, right? It's a fire sale. You mentioned earlier that despite sharing certain features in common with England and France, Japan is in a better spot. I had Dan Tubbs of Lotus Eaters on not too long ago to talk about the situation in the UK. There were former Bank of England officials hinting that the country is headed for a sort of, IMF bailout, although who knows how likely that is. So what is the functional difference between the details you've laid out about Japan and then other countries like England and France? And, assuming that there is a difference there, do you think that the comments made by, I can never remember the name, it's not Generic, it's another fairly prominent English figure, I can't remember who made that comment about the potential IMF bailout in the UK. So I guess to condense that question, what are the differences between those three nations? And if you could, do you think that England in particular is headed for a bailout?
Yeah, it's hard to say. It's really hard to say. There is kind of increasing discussion about a bailout for not just the UK, but also France. The issue with the UK, the largest issue that I see with the UK is they have tried to, debt crises do not develop overnight. A lot of people, normal people, they're used to a overnight cataclysmic sort of shock where they wake up and the stock market's down 10%, right? That sort of thing. A bank blows up overnight. And while that can certainly happen, when you're looking at something like a debt crisis, it unfolds over years, if not decades. So this is something that has been building for a long time. And what they've been trying to do is raise revenue. So if your deficit, which again is the difference between what the government spends and what it collects in tax revenue, that difference is the fiscal deficit. And one way, of course, to narrow that deficit is by raising taxes. And that is what UK has tried to do. They have tried to raise taxes. They've not really taken, and same goes with France. They have not really taken the other side, right, of cutting spending. That is always very difficult. Not only for the US, as we saw with Doge, but even more so in Europe, where they have much larger government. Like, government spending as a share of GDP over in, say, UK or France is like 50%. So over here, about 25%. It's twice as bad over there in terms of the size of the bureaucracy. And so they have tried to kind of target the revenue side by increasing tax revenue. Well, that has a couple problems. Number one, you disincentivize the wealthy who pay the majority of tax revenue, the wealthy, the millionaires and billionaires. And that's the case kind of across the board. They generally pay the majority. So you incentivize them to leave and flee. And sure enough, we've seen a record number of millionaires and billionaires fleeing the UK to avoid those kind of increased tax regime. Well, not only that, but taxes kind of by definition start to constrain the growth side. So I always point out in my various kind of debt crises videos, I always point out that debt crises are really growth crises. And it's really actually about growth. And the reason for this is what you want growth, because if you're a government, you want GDP. And the reason is because the government doesn't, people always point out, tiny little examples of where the government creates value. But generally speaking, the government doesn't actually create value. And really their prime mechanism for raising funds is to skim off of GDP, to skim off kind of the broader economic output. And that's just kind of how it is. They want the pie. If you think of a pizza, they want that pie to grow because they get a slice of the pie via tax revenue. So they want the overall pie to grow. Well, what happens if you raise taxes too much is that the pie starts to shrink. So your slice actually gets smaller. And that's basically what we've kind of started to see over in the UK. Tax revenue as a share of GDP has actually been declining. We know millionaires and billionaires are fleeing the country, and therefore, again, they pay the majority of taxes. So, yeah, they're in a tricky spot. They have pretty weak currency. Of course, we had the Liz Truss moment a couple years ago where bond yields went sharply higher. Just the past month, their monthly deficit surprised 40% higher. Their deficit, and the problem with the UK, as if that all wasn't enough, another problem with the UK is they run a twin deficit as well. So they have this very large current account deficit as well. And they have become the second largest holder of U.S. Treasuries, and this is just what happens when you shift who holds your debt from, say, a stable net productive country like Japan or China to one that is also net unproductive, that runs a twin deficit like the UK. This is kind of what you get, is a situation where they might be forced to sell U.S. Treasuries because they're running like a 5% budget deficit. I mean, just insane. Here in the U.S., our deficit is about 7% of GDP. And this is kind of like unbelievable territory, but we're the reserve currency issuers. So we kind of get away with a little bit more. Over there, their fiscal deficit is about 5% of GDP, which is enormous for not being in a recession, right? It's normal to have a large deficit during a recession or maybe a world war or something like that. But they have neither. They're not in a recession. And they're not in a world war. So they are running a very, very large fiscal deficit. A lot of that is being driven by higher interest expense, much like in the US, as bond yields and interest rates kind of broadly have broken out of that 50-year downtrend. You have higher interest expense all over the world. So again, all these countries like the US, like Great Britain, took on huge amounts of debt as interest rates were falling. And that was okay. That worked. Well, interest rates generally move in a kind of 50 to 70 year cycle. Peter Turchin has talked about this, how Ray Dalio as well. So, we're kind of in this new regime where of higher interest rates. And, for all these governments that have taken on huge amounts of debt, it becomes a massive problem. I just checked from that video on the UK. Their government spending is 57% of GDP. So over half of their economy is government spending. And revenue just hasn't grown nearly as quickly as government spending. And a huge amount of that government spending, again, is interest, which is coming as a result of these kind of sharply higher interest rates. They're trying to raise taxes. Of course, they also have demographic problems. And this is, again, not just the case with the UK, but France, US as well. We have declining birth rates. We have demographic apocalypse, really, where the very people that are kind of supposed to be funding everything and in their most productive years, right? The millennials like me or the Zoomers soon, the destitute, disaffected, destitute, dropping out of society, angry and despondent and disaffected, and not living paycheck to paycheck, and at the same time you have these kind of huge boomer populations, whether it's, again, not just the case in the US, but just in the West broadly. And in these entitlement programs, whether it's Social Security and Medicare here, which, by the way, Medicare, the cost of Medicare, the outlays for the government for Medicare alone have grown 6.6 times faster than tax revenue or GDP, going back to the 70s. So these programs are a huge, huge, huge drag for a number of reasons. Of course, inefficiency, waste, fraud is all part of it, but a larger part, arguably, is the demographic issue that kind of we're all looking at.
I think that demographic issue is a vital one to look at this, because traditionally the logic, at least as explained to me in a college level course that I was not paying attention in, so bear with me, right, was effectively something like, well, yes, we are sort of mortgaging the future, but the assumption is we will continue to grow. Productivity will grow and enable us to pay off the debts we are currently incurring in a comfortable manner. The problem is, as you mentioned, is that as a country ages, you sort of have a push-pull. You have both fewer productive people, young people who can work accomplish and build things, and also more takers. Right, you have more people on the opposite end of that. I guess, seesaw, so to speak. Are there? And I realize this might be an overly broad, overly broad question, but are there countries that have successfully managed the financial problems of an aging population, or is that sort of an economic poison pill?
Yeah, it's hard. I haven't found one that didn't include, to a large degree, just importing millions of foreign nationals. That has been the approach that, we think is bad in the U.S., kind of the surge and last administration and immigration. We think it's bad here. It's even worse in Europe. And look, from a purely academic standpoint, theoretically, that could actually work. Because if your own people are so disaffected and disillusioned and unhappy that they're not producing because their real purchasing power of their wages has been going down for at least 25 years. And I've measured this many different ways, and people can see the graphs on my Twitter profile. But if your own people are kind of over it and not reproducing because they see no hope in the future, and it's not like they own a home and they have a stake in their country or their country's success because they own nothing, like we were talking about earlier, that's all debt, then your only real option is either productivity miracle, as kind of gets into the AI thing, productivity miracle where, say, much, much more output can be done with less human input, or you just dramatically kind of artificially increase the supply of humans. Those are really kind of the only two options. And Europe has clearly chosen the latter. We know that they regulate far more than the US when it comes to, say, tech. So, they're not taking let's unleash tech. Let's hope that they develop some AGI or whatever it may be, and boom, productivity is 10% annual growth. They did not take that approach. In fact, they regulated those companies, disincentivized those companies. So they took the approach of, we'll just dramatically increase the supply of humans, I guess you could say.
Yeah, it's an interesting thing. I have a contact who is in the London financial world. I won't say more than that. And he was putting forth a theory that at least part of the bond crisis in his country, basically, and you mentioned earlier that a 10-year bond, or I guess a 10-year gilt in their system, is sort of an expected rate of growth over a decade. And obviously, if if the general conclusion is this country is not growing or things are going to get worse, right, you have to incentivize people to buy that debt, right? You have to pay them more for the deciding to fund you. Not elegantly explained, but technically correct, so we'll go with it. And one of the things he was talking about is that recently, sort of behind the scenes, there had been additional reporting done on the actual productivity of these immigrant groups. And it seems as if it had become a consensus had been reached that people like you and I might have realized a long time ago, that these immigrant populations were not simply as productive as printing an additional Englishman, right? It's not the exact same thing. And so there was a great deal of sort of wailing and gnashing of teeth over the fact that this immigration problem had in many cases actually made things worse, that they were spending even more on social services, adding more to the other side of that balance. And obviously, when we say immigrants, that means a wide variety of people. The financial analyst you're picking up from Singapore or Hong Kong is probably going to be a net contributor, whereas someone else might not be. But that is an interesting way that you describe that as sort of another bet, because it has a buried premise there that any person of a certain age is ultimately the same. And it seems as if, I could be wrong here, but the UK, continental Europe, does not seem to be in the middle of an economic golden age. That has not been borne out by the data. So sorry, Robert, kind of a disorganized response. But do you see what I'm getting at there?
Yeah. If anything, they're in stagflation. So they have in the UK about 1% real GDP and about 3.8% inflation. And their per capita growth rate is actually like 0.1%. Like it's effectively zero. And generally the same kind of general trend is true for France as well. So yeah, it's not to make a political statement. I just look at the data and read various academic reports. But I would agree that the all the data I've seen has supported that conclusion that their approach, which was dramatically increase the supply of humans, didn't really pay off. And you mentioned the kind of added cost for whether it be UK or France, the added cost from all the benefit programs, which we kind of know by definition are not the most efficient. So yeah, and they're really in a difficult place over there. Whether it be France, whether it be the UK, I would argue that they're again kind of the worst overall. Now Argentina's of course going through some issues, pretty severe issues right now. But you look at Argentina, they actually have like very strong real GDP, real inflation adjusted growth. He's brought inflation down significantly. Now he's, of course, was not a perfect politician. There's no such thing. But from the economic metrics, they're actually doing quite well. And he's actually balanced the budget. Well, not only balanced the budget, but turned a budget deficit, a structural fiscal deficit, into a fiscal surplus of about 2% of GDP. So, it's starting to bite all over the world, whether it be the US, who just kind of, we haven't really seen the full impact yet and we're the reserve currency issuer of the world. But, then you start getting into things like Triffin's dilemma, Triffin's paradox, where that's created a number of issues kind of on its own, being the reserve currency issuer. This is why no other country on earth is dumb enough to want the reserve currency status, to want a structurally overvalued currency. And in fact, we know this because the Swiss franc was seeing huge amounts of inflows in the earlier part of the year against the dollar, and the Swiss National Bank stepped in and took interest rates negative to disincentivize those capital flows because their currency was strengthening too much, which of course means that your export capacity drops because your goods are no longer cost effective for the rest of the world because your currency is too strong. And of course the sales are in your currency. So and it's not just the Swiss National Bank or Switzerland that has said this. The European Central Bank has also kind of started to warn, the euro's starting to get a little bit too strong. And of course, with two of their countries kind of already in debt crises and Germany not doing well. Germany runs a very large current account surplus and is kind of the industrial heart of Europe. So, a strong euro starts to really kind of hurt Germany. So, the European Central Bank's already kind of warned the world, hey, the euro is getting a little bit too strong. I think they said 120 is kind of their line in the sand. And we might start to see them start to intervene because we've kind of let this system, whether it be on the debt side or whether it be on the currency side, kind of the trade and globalization side, everything feels like the pendulum has kind of finally reached the extreme. And I think we're just starting to see the release of that pendulum kind of back, whether that be tariffs, whether that be, some of the things that we're seeing with industrial policy here in America, which looks a lot more nationalistic or mercantilistic with the tariffs. We're seeing very odd things here in the U.S., especially if you were kind of an old school Republican. This is not your grandfather's Republican Party. We have the government taking stakes in Intel and mineral companies and the such. So I would argue that a lot of these dynamics got way too stretched. And we kind of saw the peak in some of these themes, I guess you could call them.
Yeah, it's an interesting point. Being the world reserve currency, it's sort of a set of golden handcuffs. You mentioned earlier, right? You can break the rules. You can do things that other people can't. But at the same time, it is a major decrease in sovereignty. You're giving away, as far as I understand it, at least part of the ability to generate dollars. You're letting other people, if I understand this correctly, debase your currency. It's sort of a, what's that?
Well, so it's not quite the issue with the reserve currency is, it to some degree, you are losing sovereignty, but it's just the reason for the loss of sovereignty. What on a very, very global scale, zooming way out on a balance of payments basis, kind of globally, if you run a huge trade deficit, a huge current account deficit, where you are sending more money out to the rest of the world, again, about $150 billion per quarter than we receive from the rest of the world, well, that must be balanced. And the way that it is balanced is that a lot of that foreign capital just comes right back into financial assets here in America. So the loss of sovereignty is that by running a very large current account deficit, the other way of saying trade deficit or current account deficit is capital and financial account surplus. And so that's really the issue, is that the foreigners, because we've run large trade deficits with so many of our trading partners, they have accumulated just kind of by default, right? Like just by the nature of how global capital flows work, how international finance works, they've accumulated huge amounts of our financial assets. So the loss of sovereignty is more from that angle, right? Where now they own a bunch of stocks. Now they own, again, about $60 trillion on a gross basis. Stocks, US treasuries, real estate to some degree. So they own all these assets. If we do something they don't like, boom, they just start fire sale.
Well, Robert, thank you so much for coming on my show and sort of teaching economics for the mentally disadvantaged. This has been super fascinating, man.
Yeah, no problem.
If people want to find more of your work, what's a good way for them to do that?
Yeah, so I've been focusing most of my energy on YouTube, and the channel is called Infranomics, INFRA, and then nomics, like economics. Infranomics, that's kind of where I've been focusing most of my energy. And yeah, try to put some of these very, very complicated, I spent a huge amount of time learning and nerding out on this stuff. And I thought to myself, the average person shouldn't need to spend 20,000 hours, 25,000, they shouldn't have to go to these extreme lengths to understand how their money works, how their financial system works, how their banking system works, how international trade works. And so the goal there with the YouTube is to describe some of the the very, very complicated, very complex issues and dynamics and phenomenon into simple English, relatively simple English. I don't think I'm 100% successful with it, but I do my best to kind of explain a lot of this stuff in simple English with a ton of data, a ton of charts. I try to be as, remove my personal opinions as much as possible. Again, not perfect with that, but try to keep it, just focus on what the data is saying. So lots of charts, try to explain it in simple English. And then I also have a Twitter account or X account. It's at infra, INFRAA, 2 A's, _. And then I do have a blue check mark. I guess I'm getting to a point where I have impersonators. So if you're going on X, just make sure it's got the blue check mark.
Sure thing, man. This was highly educational. I appreciate it. Everyone, Jay Burton Show available, Apple, Spotify, YouTube, anywhere you want to check it out. Make sure to check the links in descriptions for everything Infranomics puts out. It's highly worth your time. Again, man, I appreciate it. And everyone at home, keep your head up. Life can't last forever. Good night.